You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. The polls for the House and the White House are neck and neck with less than 3 weeks to go before the November 5th U.S. elections. The complex number of results makes it difficult to plan for the wide range of possible policies and economic developments for 2025 and beyond. Fed policy and Treasury yields will depend on the path of growth, inflation, and budget deficits that stem from both today's economic fundamentals and the future policies of the election winners. On today's episode, we talk with Lucy Eve, Director of Macro-Geoeconomics with Eurasia Group, about managing risk amidst the uncertainty of this November's electoral outcomes, the economic projections under different scenarios, and the Fed policy implications over the next year onward. Stay tuned. Coming up soon, our interview with Lucy Eve, but first, a quick market update. The September CPI came in hotter than expected last week, rising 0.2% headline and 0.3% core, both a tenth of a percentage point higher than the consensus expectations. The report gives a helpful reminder that the path to 2% inflation could include some speed bumps. However, in the larger context of the previous 4 months of data, the increase should not dissuade the Fed from continuing its policy easing. Public Fed comments since the report suggest that projections for a 25 basis point rate cut in November remain intact. Retail sales rose 0.4% in September, a tenth above the 0.3% consensus. Consumer spending has stayed strong throughout the third quarter, supporting current estimates of third quarter growth above 3% from the Atlanta Fed's GDP Now model. Hurricane Milton hit Central Florida last week, adding to the human suffering and economic damage from Hurricane Helene only weeks ago. Outside the immediate impacts of these disasters, the floods and property destruction will have lingering ramifications for an unknown amount of time. October economic data, for one, could show unusual changes from the storms that do not reflect the underlying economic fundamentals. The Treasury curve steepened slightly over the last 2 weeks, maintaining the post-employment report sell-off 2 weeks ago. Yields are up slightly at the long end of the curve, with 10s testing resistance at 4%. Fed funds futures and the broader bond market are pricing in a policy trajectory essentially in line with recent Fed communication. The minutes from the Fed's September meeting, released last week, gave details about the debate within the FOMC about how worrisome labor market weakening has been and how to respond in terms of policy. Fed hawks see lingering inflation risks as reason to be patient with future policy easing. The committee's doves, on the other hand, feel the Fed needs to get ahead of maintaining the labor market recovery. That's all for the market update this time. Now, our interview with Lucy Eve. Our guest today is Lucy Eve, Director of Macro-Geoeconomics with the Eurasia Group. Lucy, thanks for coming on the podcast.
Thanks for inviting me.
Our topic today is managing risks around the upcoming U.S. elections. Now, I have to break the fourth wall a little bit here and admit, whenever we do these podcast interviews, I try to subtly weave in a mention of when we're recording the interview in case some big development changes the context by the time we edit and publish the episode. With this one, I feel particularly driven to note when we're having this discussion, the morning of October 2nd, because the political backdrop can change so quickly, and this naturally connects to this episode's main focus. So I have to start by asking, Lucy, how should investors think about managing political risk when the nature of the campaign can change so quickly?
It's a great question, and we're set for what is going to be a knife-edge vote when it comes to the election outcome in both the White House and the House races. And there's a huge range of potential outcomes that we could see there. So with where the polling is at the moment in the swing states, with Harris leading in a majority of the key swing states, but the gap being within the margin of error in most, if not all of the states, at the moment we're seeing the outcome of both races as being close to a toss-up. At Eurasia Group, we still give Trump a very narrow edge at the moment, given his advantage on the consistent top issue for voters, the economy, as well as Republicans' slight advantage in the electoral college. But we are seeing strong momentum from Harris at the moment, and she has been closing the gap on head-to-head polling on the economy. So really, this will go down to the wire. In terms of the congressional outcomes, we would expect at this point the House to go with whoever wins the presidency. Is though a closer race than the Senate at the moment, where we do see Republicans as having an advantage and almost certainly winning Senate control in the event that Trump wins. This does have important implications for your question on how investors should think about managing risks around the outcome, given this wide range of possibilities. With the outlook for the congressional races that I just outlined, in particular Republicans' edge in the Senate, we do see a Democratic sweep as having a relatively low probability at the moment. Only around 15% is what we assign to it for the time being. Therefore, we see that outcome of Harris winning and Democrats controlling Congress, which is something that she would need to push through proposals that equity markets, for example, might not like, such as a hike to the corporation tax, a higher buyback tax, or a wealth tax, as being more of a risk of a tail outcome at this point. Therefore, I think for investors at the moment, there are three key scenarios that we'd focus on as the more likely outcomes for the time being. Firstly, is a divided government under Harris. That's something we assign about a 30% probability to, where we'd expect to see broad policy continuity. And that's the most market neutral scenario, with a potential slight shift to the left compared with Biden. And then the next scenario with about the same odds is a Republican sweep, where we would see more sweeping changes implemented by Trump through higher tariffs, a significant tightening in immigration controls as being the key drivers there. And then finally, we have the possibility of divided government under Trump. That's something we'd assign about a 25% probability to. Trump would be able to pass much of his tariff and tighter immigration scenarios in that outcome, but he would struggle to pass a corporate tax cut, for example. So still quite a range of outcomes, with the most likely scenarios ranging from broad policy continuity to tariff and immigration controls of varying degrees, plus obviously the risk of more expansionary fiscal policy. So that's the way that we're kind of assessing the key most likely outcomes at the moment and their likely policy implications.
I think that's helpful, assigning different weighted probabilities, because there's so many different combinations of who is going to win the different branches of government, or within the legislative branch, how the House and Senate are going to turn out. Now, back when President Biden was still in the race, you might remember it was like 50 years ago this past July, the bond market seemed to react to any news that increased the likelihood of a Trump win with a bear steepening, which means yields would increase, particularly at the long end of the curve. And the apparent intuition is that Trump's policies were going to be inflationary and also increase treasury deficits, the so-called Trumpflation trade. I don't think I've seen any clear instances of this in the last few months since Kamala Harris took over the candidacy on the Democratic ticket. How do you think the bond market is viewing the presidential election right now, both the probability of who will win and what their victory would mean for policies that impact bonds?
Yeah, it's a great question. And I agree with you. I don't think the market is really pricing in a significant possibility or probability at this point of a very inflationary environment from Trump's policies. And I think overall, given the closeness of the race at the moment and the range of possible outcomes, from both in terms of the election outcome itself and the policy outcomes, from an investment perspective, it is making it hard for a lot of our clients and investors to think about making directional bets that are related to the election with any kind of great degree of confidence. So on the back of that, we're seeing investors looking to perhaps more to option trades rather than directional bets or betting on a steepening of the yield curve, given the level of uncertainty that's out there at the moment. And I think also it's worth thinking about what we've seen in the yield curve in the context of the sharp shift in market expectations for Fed rate cuts in the last month or so. That seems to have been a much bigger driver of overall bond market performance, at least more recently. So I would agree with you that when we're thinking about the economic implications of a potential Trump administration, many of Trump's proposed policies and where we think they're likely to pan out will have a significant inflationary impact, particularly on tariffs and tighter immigration controls, but also the potential for more expansionary fiscal policy. One other important angle to it as well is the potential for Trump to lean on the Fed to keep policy looser. Whether that actually impinges on the Fed's independence, particularly under Powell, remains an open question. I guess bringing this back to the steepness of the yield curve, we did see the yield curve steepen initially when we had Biden in the race and we saw Trump's odds of winning the race, or the perception of them, increasing. But I think it's also worth bearing in mind a significant amount of that was driven by a larger decline in short-dated yields on rate cut expectations, as opposed to a kind of sharp increase in longer-dated yields. And if we look at sort of the 10-year Treasury rate at the moment, the actual level of the 10-year yield is still significantly below the peaks that we saw in the middle of the year. So we're really, in that context, not pricing in a very substantial increase in what we would see as the long-term rate under Trump. I think if we also look at other measures or potential indications of rising expectations for a Trump presidency. Other measures like inflation expectations also remain at relatively low levels and have been much more driven recently by the outlook for Fed policy making. So all in all, that could indicate a couple of things. So either investors staying on the sidelines for now in bond markets when it comes to election bets, just given that closeness of the race and the degree of uncertainty, but also potentially investors assigning a relatively low probability of Trump winning, and being able to pursue the more inflationary aspects of his policy agenda.
I think when people ask me about, how to manage risks around the election or what are the implications from who wins on November 5th, it feels like a cop-out, but it really is all about an uncertainty. And so you've talked about weighting probabilities for different outcomes, but even within the winners, I sometimes struggle to see or really have a clear expectation of what the policies would be under different combinations of winners of the White House and Congress when it comes to magnitude. When it comes to fiscal policy and the deficit and growth and inflation, I imagine you've got to have a baseline expectation for how things will unfold under the two candidates of Harris and Trump. And that really comes up against a backdrop of, okay, well, how cooperative is Congress going to be? What are the courts going to allow them to do? If you remember, a big kind of fiscal policy for President Biden was student loan forgiveness, which was overturned by the Supreme Court. So there's so many different variables, but you do have to have a baseline expectation. I've got to think in the Congressional Budget Office and other think tanks have come up with projections for what's going to happen to the deficit and the economic outlook. What is your baseline expectation for the two major candidates if they win when it comes to inflation, the deficit, and growth over the next 4 years?
So perhaps I'll start with the deficit. And one commonality under both Trump or Harris would be that no matter the election outcome, deficits are going to continue to rise through the 10-year budget window. I would expect both Trump and Harris to be reluctant to take on entitlement reform, and neither are really willing to take tough action to rein in the deficit. So that's the overall backdrop that I would kind of incorporate into that baseline. So at the moment, the Congressional Budget Office is projecting deficits to average around 6.3% of GDP over the next 10 years. Our assessment at Eurasia Group of a more realistic current policy baseline, which assumes that the Trump tax cuts are extended in full and that spending grows at the rate of inflation, would lead to average deficits of around 7.4% of GDP over the next 10 years. When we're thinking about the degree of difference between the two election outcomes or the various different election scenarios, depending on where the congressional outcomes end up, the range of average deficits over the next 10 years we see as being at the smaller end, around 0.4% smaller than that realistic baseline that I mentioned, and on the upper end of the scale, a 0.5% as a share of GDP larger average deficit over the 10-year period. So quite a wide range there. If we're thinking through to the end of the next presidential term and what that means on a cumulative basis, we're talking about a deficit range of between 6.9% under a Harris unified government and around 7.8% if we see a Trump unified government in 2028, with divided government somewhere between the two. So quite a large range there. And I think perhaps before I go on to talk through the expectations for inflation and growth under the various different election scenarios, it's worth also briefly touching on where we see the range of policies panning out from Trump in particular on trade and immigration. On the trade front, under Harris, we'd expect broad policy continuity, but on Trump, we're expecting a quite aggressive use of tariffs. Now, clearly, he's called for very protectionist measures like a 60% China tariff and a 10% across-the-board tariff on the campaign trail. We do think that he's unlikely to deliver on his maximalist proposals, but we do still expect a substantial increase in tariffs. So we think, for example, that the current Section 301 tariffs would increase from a top rate of 25% to a top rate of around 40 to 50%. And that would mean that the effective rate on all Chinese imports would rise from around 13% to around 25% in the first year, with the potential increase to as much as 30% by the end of the administration. We do, though, see the 10% across the board tariff as being unlikely and would expect China to be the initial focus of tariffs, but would still expect some actions targeting Europe and other trading partners in 2026. And then on the immigration front, again, Harris broadly policy continuity. But on the Trump side of things, we would expect him to pursue between 1.5 to 5 million deportations over 4 years, though more likely on the lower end of that. And clearly that has important economic implications as well. So I think it's important to credit the rising share of immigrant labor has been an important driver of the US's ability to achieve disinflation and still relatively resilient growth in the last year or so. So it's an important factor in its ability to achieve a soft landing. Clearly, a much tougher stance on immigration would have profound implications both for inflation and growth.
I want to dig a little bit more into those tariffs and trade policy because I think oftentimes the analysis focuses on the first order effects, which is, okay, tariffs increase the price of imports by this amount, which means that maybe growth goes down this much or changes inflation this much. But there are obviously knock-on impacts because there's what tariffs represent. Whenever tariffs are enacted, I think foreign countries feel like it is an unfriendly gesture, even if the direct implications are small. And so you've got to think that there is some retaliatory behavior from foreign countries. So if those Trump tariffs go ahead, whether it's 10%, something smaller, the bigger tariffs against China, will it impact foreign demand for treasuries? Because I think that has been a big part of how this increased supply of treasuries has managed to be absorbed by investors is that you have a lot of foreign central banks that have added it to their balance sheets. A lot of foreign investors still like treasuries. But if we start erecting these trade walls and there's a tit for tat where suddenly foreign investors are not interested in treasuries or they're not interested in the dollar as much, could there be a second and third order impacts that go beyond just the increase in prices that we see from tariffs?
It's a great question, and I think it's worth thinking about the risk to treasury markets and to foreign treasury demand, not just in the context of potential trade retaliation and tariffs, but also in the context of an environment where you have other factors that would put upward pressure on treasury yields, whether that's the impact of immigration policy or a potential expansion in fiscal policy. So I think the combination of all of those factors does risk driving more volatility in treasury markets, particularly given the level of uncertainty about where policies will actually pan out, and also given the likely use of maximalist threats, even if not ultimately agreed, as part of that negotiation policy on trade and tariffs. So I think all of those do risk having somewhat of a dampening effect and being a significant source of volatility. But I do think it is also important to remember that we don't think that the dollar's position as a global reserve currency, as a safe haven, is going anytime soon. We think that the factors that could drive more volatility in treasury markets could clearly be a source of concern and market illiquidity and so on. But I think we're still at a point where the US economy remains a dynamic, innovative economy that's going to continue to attract substantial and significant foreign inflows. So we're not in a position where any of that is in doubt. But are we headed for a more volatile road ahead in treasury markets? There's clearly a real risk of that.
In theory, the executive branch is equal with the other two, the legislative and judicial branch. But I think we've reached a point in U.S. politics where there is this idea that the president really sets the tone for, the congressional members of their own party. And so there are a lot of promises on the campaign trail that really aren't left up to the executive branch. And sometimes they're totally unrelated to what the president can do. But there are certain things that the executive branch can do unilaterally without congressional cooperation. So when we think about that, what are the economic policies that are most important to focus on that both the two candidates are kind of promising that won't have to deal with this variable of, okay, well, who's going to win Congress? There are certain things that the executive branch can do on their own.
Sure. So in areas like trade and immigration policy, the president does have the authority to pursue a significant degree of policy changes unilaterally. Though congressional control can still limit the more extreme end of some of the changes in those areas. So, for example, on trade policy, Trump could announce significant tariff increases, but he would be constrained, for example, on potentially repealing China's permanent normal trading status or the institution of a border adjustment tax. But if we're talking about, a very substantial tariff increase, up to the 40s, up to the 30s, 40s, he would not be constrained in doing that and would be able to approve a lot via executive orders. On immigration policy as well, Trump could curtail parole policies, raise the bar for asylum claims, and reinstate other policies to clamp down on migration. But he would be unlikely to be able to pass a sweeping immigration reform, which would need the elimination of the filibuster. So overall, he's relatively unconstrained in pursuing all but the most extreme end of those policy proposals. When it comes to fiscal policy, though, given the impact of the filibuster, any policies that would increase the deficit after 10 years would need 60 votes to pass and therefore require a level of bipartisan support. So that means that the odds of a substantial corporation tax hike under Harris or a potential cut in the corporate tax rate under Trump would be limited given the weak prospects for bipartisan cooperation on that issue. So overall, we would think that congressional control is likely to provide more of a constraint on Harris, given some of her key policy proposals, like a corporate tax hike, are unlikely to pass with bipartisan support, while Trump would be able to make much more progress on some of his key policy priorities, like tariffs and immigration, through executive actions.
What about when it comes to financial or environmental regulation? I know sometimes the laws that are passed by Congress are vague enough where the level of enforcement or prioritization is up to the White House, whoever the president is, and what they feel. Kind of they have discretion over how much they like that policy and how much they want to follow through on it. So are there certain financial industry regulations? I know we've seen the Basel III Endgame come through this year and then also go through some reforms. Are financial regulations something that Harris or Trump could change unilaterally? Is it more up to the Fed, or how do you see those things?
When it comes to the Basel III Endgame proposals, we've already seen a significant watering down in the reported plans. So I think overall, we're expecting the bank capital requirements, regardless of the election outcome, to not be on the more kind of extreme end of where we might have expected back a year or so ago. When it comes to deregulation, we would expect Trump to pursue a more deregulatory agenda. Now, in terms of where that ends up, I mean, we would expect there to be a significant amount of Republican support in Congress for moves to push through deregulatory initiatives. But I think another important consideration will also be the stance of the courts. And also, clearly, they're going to need to consult with the Fed on all of this. So the outlook there is still relatively unclear. But I think if we're comparing or thinking about the risks of a sharp tightening in regulation on the banking sector, the risks do appear to be lower than we might have anticipated them in the past in this upcoming election cycle.
I want to ask a couple questions about Fed policy. So when I think about the election winners, so the election is November 5th. We almost certainly won't have a winner by November 6th. But the newly elected representatives aren't sworn in until January. And then even after that, of course, it takes time to pass legislation. And then after the legislation is passed, it takes time to channel into the economy. So when it comes to the Fed's policy path over, I don't know, the next 6 to 9 months, is it based on fundamentals that are already baked into the macroeconomy? When will we start to see the elections having enough of a change on policy that it would change the inertia of whatever trajectory Fed policy is on right now?
So I would think the outcome of the US election would be unlikely to meaningfully impact the Fed's decision making over the next 6 to 9 months. And that really continues to be driven by the economic fundamentals themselves and data as we see it coming in. When it comes to the timing of the implementation of the policies that would have the biggest macro impact, so namely tariffs and immigration that I mentioned before, there will be some lag in terms of when they actually come into place. And that really means that major policy changes are unlikely to be implemented until mid to late next year and into 2026. And therefore, the economic implications of them would only start to bite in the second half of next year and onwards. The key time frame we therefore think is worth watching is towards the end of 2025, when this could really start to influence Fed decision making a little bit more. If we see Trump follow through with a more material increases in Chinese tariffs, that will take some time to come through. We wouldn't expect that before the second half of next year, but that could flow through to the economy relatively quickly. On the deportation side, the actual economic impact of that and therefore the Fed reaction function may be a fair bit slower. But in terms of when this might start to impact Fed policy making, the second half of next year, I think, is the timing where this could be a more important factor. If we're looking at what markets are pricing at the moment, so we have around 160 basis points of cuts priced from now through to June next year, with one additional cut by year end. In the event of a Trump victory, that additional one cut does look like it might be unlikely until we have more clarity on the outcome when it comes to tariffs. And overall, we think that additional cut does look unlikely. And in general, our view is that 160 basis points of cuts that's priced in does currently look quite aggressive. In the event that Trump were to deliver on his more maximalist proposals when it comes to the tariffs and take an aggressive approach on the immigration side of things, we could even see the Fed at the beginning of 2026 need to start thinking about a potential tighter approach to monetary policy again. Clearly still some way out and a lot of uncertainty around the eventual outcomes, but in our minds, this is more of a end of 2025, beginning of 2026 type scenario that we're talking about.
Recently, we've seen some increased politicization of the Fed. So there's some Democratic senators that wrote a letter to Chair Powell saying, you've got to cut rates now because the labor market is weakening too much. And then former President Trump said publicly that, cutting rates this close to an election is election interference. And this jawboning is nothing new. I think really... presidents have always commented about Fed policy up until President Clinton, where there was this idea of central bank independence really solidified. But there seems to be a sense that central bank behavior is becoming more connected to politics around the world. And this is too bad, I have to say, because I think research is pretty clear in showing that central bank independence is a really good check on inflation, because central bankers can kind of form their behavior based on the long-term good of the economy rather than being incentivized to think about the short term and whatever the next election is. What do you think the chances are that the Fed or other major central banks become so politicized that they lose some of their independence in, let's say, the next 10 years? And I know we're nowhere near right now the Fed being kind of a puppet of the White House, but of course that credibility, that independence erodes slowly over time. And so, of course, thinking about the next step, the first step of that total lack of independence is important to stop.
I think you're right to highlight the noise that we've been hearing recently around monetary policy. And also we have had comments from Trump more recently when it came to the 50 basis point rate cut, saying that, it could be a question of the Fed's independence, or it could be a sign that the economy is in dire straits. So I think it is important to take note of that. Overall, though, I don't think we're going to see a wholesale shift in the Fed's independence over the next 10 years, but we are likely to see continued noise around monetary policy. In terms of the Fed itself, there would be huge resistance from within the Fed to any threats to its independence. And I do also think that the market reaction to worries about the Fed's autonomy and the likely volatility that would result in would also act to deter any future leader from considering such a move. I think it's also worth considering the outlook for the fiscal deficit and the fact that we expect that to continue to grow. You mentioned the very well-known and recognized literature out there about the benefits of central bank independence. But I think if we're thinking about that as well in the context of a continued rise in fiscal deficits and the possibility that that drives more treasury market volatility, I think there would be a recognition ultimately that regardless of the future election outcomes, that an erosion of the Fed's independence would risk unanchoring inflation expectations and driving market volatility that would be ultimately counterproductive. So that doesn't mean we might not see some volatility first in markets as future leaders test that, for them to be convinced that pushing the Fed for easier policy isn't worth some of the medium and longer term costs for only a short-term boost to growth. I think we could see more noise there, but ultimately we think that there would be a great deal of resistance and a recognition that ultimately it doesn't work in their longer term goals. If we're looking beyond the US as well, others and among several central banks globally, we have seen noise elsewhere around monetary policy also pick up. And we're seeing that as we're seeing continued cost of living pressures, even as inflation has moderated, leading to some leaders pushing for easier policy. We've seen that in the likes of Thailand. in Colombia or in Brazil. And I think the example of Brazil is quite an interesting point, where we've seen President Lula repeatedly criticizing the current central bank governor, Campos Neto, and his tight monetary policy stance calling for rate cuts. But despite his criticism of high rates, Lula's picked a more moderate replacement, Galípolo, who was even voted last month for the central bank to hike rates, which has kind of led to a kind of easing of market concerns about the risk to political independence there. And I think there are a few interesting takeaways there, that a lot of the time some of this criticism that's directed towards central banks can be more related to perceptions of a central bank governor not being politically independent and personal issues that leaders may have with central bank governor, as opposed to signalling a broader wholesale shift in support for a more unorthodox policy outlook, for example. And that's something that we would also expect under Trump as well. He will criticize Powell's decision making if he were elected, but we do think that he would be unlikely to opt for a more unorthodox name to replace Powell once his term ends. And we also see the odds of him firing Powell before his term ends as being unlikely.
In the US, congressional elections happen every 2 years. The presidential election happens every 4 years. This is a form of accountability. This is democracy in action. But it also means that the people in power are changing somewhat frequently. And I wonder, do you find that investors or business decision makers feel like there's too much volatility between the different administrations? So, we are talking now about what happens after the November 5th elections, but whatever that landscape looks like, it's going to change in 2 years. It's going to change in 4 years. And that rate of change has always been the case in the history of the US, but now is there more volatility between administrations, between whoever wins those elections, and does that make it unpredictable for people to make investment decisions? Because, of course, whatever happens in the next 2 years could be completely reversed. All the policies we've talked about can be completely reversed in only 2 years or 4 years.
It's a really important issue, and I think policy uncertainty has always been a feature of election cycles, as you say. But the fact that we're seeing rising polarization in the US and an erosion in the quality and predictability of US institutions is an important factor as well. And I think question marks around America's role on foreign policy and becoming less reliable as a partner when it comes to international cooperation do also make it harder for businesses to have clear, stable guidelines and demand signals that they can plan around. So if investors are having to ask, will Inflation Reduction Act incentives still be there if Trump wins, or will my policies be overturned or will certain policies be overturned at the state level or by the courts? We are in a more uncertain environment given how the institutional framework in the US is evolving, and we would see more risks of institutional degradation and more policy unpredictability in the event of Trump coming to power. When it comes to making long-term decisions, while the high level of uncertainty on the policy front does make it hard for the business community to operate, the question does still remain, what is the alternative to the US? With the US economy still currently looking like it be set to achieve a soft landing, we're seeing the continued resilience of the US stock market and the ability of the US to drive innovation, grow profitable businesses, be such a strong and dynamic economy, as well as all of the factors that I mentioned earlier, like its role as a reserve currency and safe haven. While these political risks and some of the more extreme policy proposals on the table at the upcoming election may hit growth and boost inflation, some of the kind of bigger questions around the dollar's role as a safe haven currency are, we think, very much longer term questions and tail risks. But nonetheless, I think these uncertainties do mean that an assessment of geopolitical risk is becoming an increasingly important factor for businesses and investors to actively manage and to keep track of, not just at the national level, but also internationally and at the state level.
We've talked a lot about how the effects of policy will have lags, whether it is how long before legislation is passed, how long before it channels into the economy, and then the Fed reacts, etc. But I want to finish with a question about what financial markets generally do on election night. Do they react only when there's a surprise? Do they rally because now uncertainty can be priced out? Do they favor one party over the other? Does it depend on some combination of how Congress and the White House turn out? What do you expect will happen the morning of November 6th when, or whenever the results are announced? What can we kind of expect at first from financial markets in early November?
So the extent of the move that we're likely to see on the day after the election will depend on the outcome itself, but also the scale of victory, in particular whether the winner has a clean sweep in Congress and the extent of policy changes that are expected on the back of that. Also, clearly, whether that outcome has already been priced in was unexpected. At the moment, we're seeing S&P options currently implying around a 2.5 to 3% move on the day after the election, which is roughly similar to what we saw at this stage of the election in 2020. This time around, we would expect to see a significant market move on the results themselves, given, particularly in the event of a Trump victory, given relatively little seems to be priced in markets, particularly in the rates market at the moment, to indicate that markets are assigning a high probability of him winning. And if we're thinking about the risk to equity markets, we would think that the scope for an equity market rally similar to what we saw on the back of Trump's previous victory as being lower this time around. Firstly, pre-existing conditions are quite different for markets. Valuations are much higher. And when we're thinking about the outlook for potential tax cuts, this time around, we would think that individual tax cuts would be more likely than corporate tax cuts. So we are looking at quite a different market environment now to what we saw previously. One other factor to mention as well is the potential for volatility in the immediate aftermath of the results if we see a very close outcome. Particularly in the event of a close victory for Harris, we would expect to see some recounts, challenges to state and local vote certification, could also drive some legal uncertainty and volatility for several weeks, if that outcome of the race does still appear unclear. Ultimately, though, legal mechanisms should likely resolve any challenges before the 17th of December deadline to submit electoral results to Congresses, but that doesn't mean that we could have some significant volatility in the run-up to that as the actual eventual outcome becomes clearer. So overall, it really is looking set to be an election that will go right down to the wire and does have the potential to drive significant market volatility in the immediate aftermath and potentially beyond, depending on the outcome itself.
Lucy Eve, thanks for coming on the podcast.
Thanks for having me.
That was Lucy Eve, Director of Macro-Geoeconomics with Eurasia Group. I thought everything Lucy said there was helpful in putting the upcoming elections into perspective. Even with the uncertainty surrounding electoral outcomes, it's useful to put the highest probability on the scenario where Kamala Harris wins the White House with a divided Congress, and the scenario where Donald Trump wins with a Republican-controlled Congress, a so-called sweep. The deficit is poised to increase no matter what, though divided government looks like the most likely scenario where its growth does not accelerate. Also, Fed policy should be on a fairly steady path until the middle of next year, no matter the election outcomes. A handful of Fed speakers fill a calendar over the next 2 weeks before the pre-meeting silent period begins October 25th. Chair Powell is so far not scheduled to speak publicly before the next meeting. Fed funds futures are currently pricing in a 95% probability the Fed cuts rates by 25 basis points at its November 7th decision. The September JOLTS will be released October 29th and show the latest details on job openings, hiring, and quits. The report can be volatile month to month in normal times, and Hurricane Helene may cause even more noise than usual. The next day, the advance release of Q3 GDP is expected to show another quarter of strong economic growth and a slowdown in core PCE inflation from the second quarter. The September-specific monthly data will be released the following day. The core PCE deflator is expected to have risen somewhat last month, though the 3-month trends are still encouraging enough to keep most within the FOMC in support of future rate cuts. The October jobs report will be released November 1st, the last major economic data before the November 5th elections and the Fed's November 7th policy announcement. We expect that Hurricanes Helene and Milton will distort the fundamental labor market trends, along with striking workers at Boeing. The Fed and financial market participants may find it prohibitively difficult to parse out the noise from the signal in that report, preferring instead to see September data as the most reliable gauge of labor market strength. That's all for today's episode. Thanks again for listening. I'm Will Comperl, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.